All right. Now joining us is Daniel Want from Let me try that again, Linus.
I told you he wouldn't be able to do it. First
All right.
take. Let's see if he
All right.
makes it on the second.
All right. Here we go.
I'm a seller.
All right. So joining us now is Daniel Want from Prerequisite Capital. He's the co-founder and portfolio manager there. Daniel, how are you doing?
Yeah, good. Thanks, guys.
That's good. So you've come to you created a nice slide deck presentation that for us to share with all of our listeners, and I thought it was great what you put together. So I'm looking forward to going through all of this with you. So one of the first things you put on here is the idea that the next 25 years is not going to be anything like the last 50. And so why don't you share with us what's on your mind and where you think this is all going?
Yeah, sure. No, just like everyone else out there, we've all been loosely wrestling with the same sort of issues and how do we navigate things, given the fact that there is so much going on out there and we're sort of dealing with the overhang of, a multi-decade global indebtedness cycle. And, we're talking about all sorts of, and actually trying out all sorts of extreme policy measures. And they only appear to be, set to get more extreme as the years unfold, and we need to deal further with the different imbalances and unsustainabilities that have built up out there in the system. And so, for the last 50 years, we've generally had tailwinds, at least in most of the Western world and even in the peripheral world, of obviously a never-ending debt cycle. We're always expanding credit, and we're always moving in the direction of sustaining investment structures and economic structures. God forbid we'd have any form of a material washout and reallocate resource to more useful purposes.
Now, Daniel. So I wanted to ask you this, and so when to me, and what I kind of look at this zero or negative interest rate policy that we are seeing out there in that environment is this period of financial repression. What's your intuition as to how you think that this kind of ends? Or do you believe that it's just going to perpetuate even for even a decade longer, just in the same state that it is? Like, do you think that there's a transition point coming?
Yeah, I mean, when we look further out, my suspicion, I wonder sometimes whether these bond markets will end more in a whimper, but the currency markets will end in a roar, because governments just cannot, they're not really going to be able to allow, especially sovereign bond yields, to materially get out of control. And the nominal yields in their sovereign debt, they have a lot of measures, and even if they do just directly buy them, but obviously what they can't control is their currency, and what they can't control are the capital flows past a point. They can try and put capital controls in, and unfortunately we're probably going to go into a world, at least over the next 10, 15 years, as we're more, we're dealing with a lot of these issues, where capital controls will start to predominate more and more, especially in the rest of the world, and maybe between the major financial centres, like the UK, Australia, or not Australia, but the US, and just some of the, there'll still be reasonably free movement of capital, I'd imagine, but it will be more, on a selected basis, and there'll be
Right.
qualifications to everything
Right.
else,
Right.
I'd guess.
So on page 5, you do a great job breaking down what you define as like the 7 primary risks in the markets, and they all make perfect sense. But you particularly highlighted portfolio risks and the fact that, or the risk of insufficient diversification. Why did you highlight that one as the key risk that you wanted to kind of bring to people's attention?
Yeah. Well, actually, this is just an image that I threw on from a different presentation, but basically, you know, when you look at the way the average portfolio is constructed, it's largely optimized and quite efficient for the last 50 years of experience, right? And whereas the next 25 years of experience, I'd imagine are going to be very different. And when you look at pretty much any asset class, any market, even pretty much any currency, they all map to a different combination of, you know, growth or inflation and capital flow type, you know, underlying factors and drivers.
Right.
And so one of the things we know is that, you know, over the next 10 years, we are naturally going to only morph into a different combination of growth, inflation, and capital flow conditions, right? Really, all we experience in markets and portfolios is just a rearranging of those, you know, three primary factors. And so when different factors are, you know, improving or deteriorating, you know, different asset classes or different markets tend to, you know, move up and down in line with those things. And so if we know that in any given point in time, like tomorrow we wake up and, you know, say there is some form of a crisis, or there's actually more of a positive shock, whatever it is, you know, if growth is declining or we're moving into some form of a recessionary condition, then cash tends to be king. If growth is improving, then equities is largely where you want to be. If we've got deflation, then it's the, you know, sovereign bonds, especially duration, longer duration sovereign bonds that have, you know, governments that have a lot more room to move. And so don't necessarily have the sovereign credit risk as pronounced. Excessive inflation, precious metals, you get the idea. And so if we start with a foundation in portfolios construction, at least in our liquid portfolios, where we've got those primary elements, then that gives us a degree of resiliency and even uncorrelation to most things that move. So whatever we get surprised with, it will naturally prove, you know, a degree of resiliency.
So Daniel, what I love this idea of insufficient diversification, because I've personally been skeptical of the way we have always diversified. Like, I want to know what you define as diversification, because during a liquidity crisis, where the scarcity is in cash, the correlation of all assets during some sort of a liquidity event all go to one, and everything goes down simultaneously. And so all of this mapping you do of correlations just gets thrown out the window. Like, how do you properly diversify to remove that kind of a risk?
Yeah, well, what we're really talking about is not necessarily correlation when we start to talk about, say, a liquidity event. And this is where having more of an understanding of the systems nature of the world we live in is more important. So understanding the plumbing of the banking system and how all of that works, because ultimately you only ever have two categories of asset, so to speak, or categories of securities. You have either confidence assets or collateral type assets, right? Now, in this 7 primary risks, for example, 3 of those, you know, so cash, sovereign bonds, and precious metals are more of your historic sort of typical collateral type assets. So in a liquidity crisis, what are you going to be scrambling for? Collateral. Well, that's what everyone's going to be scrambling for. And so half of the strategy here in trying to build in a degree, or at least a foundation of resiliency, is that you're going to own a bunch of collateral before everyone else realizes they need it, right? Mm-hmm. And so in the midst of a liquidity crisis, and this is where a systems understanding of how things work is pretty essential, because what is collateral and what is a confidence asset will change in different systems regimes. Right. Once upon a time, or depending on where we're at, real estate can be a collateral asset, right?
Right.
And if it's not underpinned by a whole world of unsustainable and excessive credit. And so a scramble for collateral, especially if you're in more of an inflationary environment where a scramble for collateral is more towards, say, precious metals or real estate that's not underpinned by a big, you know, credit excess. Whereas in other systems regimes, the collateral asset actually, you know, real estate is more of a confidence asset, and it's going to get smoked because of the credit structures underneath it.
Right.
And the same goes for currencies. Currencies fundamentally by nature, depending on the context that they're in or the broader system structure that they're in, they'll either tend to be more of a confidence type currency in the world, or they'll act more like a collateral type currency in the world. You know, the Swiss franc for a long time has kind of been a bit like that. The yen up until now has kind of a little bit been like that in past regimes. The US dollar definitely now is the ultimate sort of collateral type currency. And so it actually has a couple of things working for it in that, you know, generally it actually can benefit in confidence and collateral demand type conditions. Because of the way everything's wired.
So do you still believe there's room for the U.S. dollar to continue the uptrend? Do you have a stand on what you think the U.S. dollar is going to do here?
Yeah, it's sort of like all roads lead to Rome. It's all roads lead to the US dollar. Ultimately, as this structural environment unfolds, at least in the initial phases, past the point in the years ahead, you're going to want to run from the US dollar. But I think a lot of the context, or at least a lot of our frameworks and the analysis methodologies, it's just that drive towards the US dollar on a multi-year basis is quite unrelenting.
Kevin is in the safe haven of the pound sterling. That's
you couldn't resist getting a dig in there. Daniel, we're having a look at page number 8, and I must say this is a chart near and dear to my heart. And we're looking at is the 30-year Treasury, and then you have some sort of tool that you have for measuring liquidity turning points, and you have minor and major signals, and it looks like one of the minor signals was just hit. And why don't you walk us through what this is meaning, how you come about figuring out when those things are hit, and what it means for the bond market going forward?
Yeah, so in the slides leading up to that, I kind of provide a bit of a synopsis about the underlying theory. So like when any marketplace starts to lose a degree of diversity amongst the positioning of its participants and what's been working for them and all the rest of it, and nothing rewards or nothing reinforces a view or a positioning or a trading strategy like a gain, right? And so when the fundamental or the underlying market structure starts to move to a highly unified state, that's when that market actually, everyone's bought, everyone's a buyer, all of the bears have basically been punished and they've capitulated and thrown the towel in. They've probably been trapped much lower anyway. When it moves to that point of
well, I have to jump in here. Let me let's double check. Kev, are you flat now on bonds?
No way, baby.
No. See, then this indicator is wrong.
No, that everyone's covered. I know. I've taken stabs at it, but let's just finish, Daniel.
All right, so go, Daniel. Sorry for interrupting. Go.
How do you? Get,
so it basically identifies a critical mass. So the maths under that is more like using fractal type math and trying to. A lot of the stuff I've learned about market positioning and how participants behave and structure and all of this sort of stuff, I was able to crystallize into basically a fractal type algorithm. So it identifies critical mass conditions, and at those critical mass conditions, you get a high probability of some form of a turn. It's almost like when there's a diversity of positions and views and argument almost in the marketplace, that's almost like an abundant liquidity condition. But when you get a lack of diversity and unification and excessive unified positioning and all of the rest of it, that tends to precede a shift or the significant turns in markets. And so now, some of the work
so Daniel, from your lips to God's ears, hopefully, because I'm about as lonely as Patrick at his grade 12 prom. Being a bond short here.
So Daniel,
this doesn't actually mean that you want to go short bonds, by the way, but it just means there's a high probability that we're either at an intermediate sort of top or turn, or we're just about to correct for a material amount of time. And I'd only put it's a 70-80% sort of probability whenever you see these things triggered. And we just got one in gold, by the way, too. And so
Oh,
it's sort of
really?
like we've had this scramble for collateral in the last, I don't know, 6 months.
Yeah.
And, it doesn't matter what collateral you owned, whether it was, precious metals or treasury type exposures, they both did interchangeably as good as each other. But we've just we've had these things starting to trigger, and that normally means sit up, pay attention. And
So
we've also
so
had surprisingly, a lot of our other sort of money flow models are all sort of set up that we could get much more of a material correction in treasuries than people are realizing. So, maybe Kevin on a short-term
yeah.
basis.
Okay, so what I wanted to ask you then, though, how do you think this plays out? You chose the 30-year, so you went to the a far part of the yield curve. Do you think that this could result in the steepening of the curve? Like, do you still think that the 2-year and the Fed funds rates could potentially go lower, but then we have yields just pop higher on the long end of the curve with a steepener? Is that how you would think that this could play out, or do you have a different view on how this
Yeah, when we start talking about the yield curve, if you were to put a gun to my head, I'd imagine it's probably going to stay inverted or continue to just sort of flap around for quite a while. I think we're probably still 6 to 12, maybe even 18 months, I'm not sure, before a material steepening dynamic kicks in to the yield curve. Normally when you get those like aggressive sort of steepenings of the yield curve, they're pretty much tantamount to domestic conditions that are like scrambles for collateral, confidence crashes. And, that's actually when the yield curve is really starting to, steepen in a reflexive way. That's usually when you need to be out of risk assets or confidence assets. And that's when you need to get worried about the equity market. But
it's
while
because
it's inverted, you actually don't need to, well, I would never say you don't need to worry about the equity market, but, while it's inverted, that sort of actually just means we've got an under appreciation of, the need for collateral in the system, and confidence is still, probably a little bit excess, but it's more of a trapped confidence in that people are starting to realize that the system has gone too far. They're trying to scramble more. It's harder to find funding. There's maturity mismatches that are all starting to, strain.
see? Yeah, but to me, if the 30-year has just gone too far, the moment we see that revert, unless the front of the curve sticks with it, then that should cause a steepener. Am I wrong? Like
Oh yeah.
if we see that
I mean, if
reaction,
you're talking about I'm talking about a steepener that it's kind of like tantamount to 2008
right?
sort of steepening. Now, if you're talking about a trading horizon of say 3 months, or yeah, sure, you probably get a little bit of a bounce towards a steepening direction. Maybe,
Right.
I don't know, but I tend to not operate on a sub 3 month or a sub 6 month
Yeah.
even time horizon. A lot of what my methodologies are more geared to say a
A
6 to
macro.
24 month time horizon.
Right. Right.
Um,
That makes
Okay.
sense.
Well, Daniel, it's been great having you on. Why don't you tell people where they can find you and learn more about your methodologies and what you do? And so why don't you give us your website and your Twitter handle?
Yeah, so our website is prerequisite.com.au, and we've got a lot of quarterly letters there. We tend to go into a lot of detail on a lot of different subjects. You know, they're a good read if you want to try and get an understanding for how we look at the world and some of these different tools and methodologies we've evolved. And also, I'm sort of on Twitter. It's sort of sometimes I go through seasons and tend to do things on there, and other times I disappear. But Daniel J. Want is the Twitter handle,
Okay.
and you'll see me there occasionally.
Okay, great. Well, and for those who want to hear more from Daniel, make sure you stick around for the after hours where we're going to talk about what's happening down under and the black swans that are going through his lawn.
Sounds good.